Preview.
Can you explain a little bit more about what a purchase price allocation is and why it's necessary?
Sure. So from a GAAP perspective, a US GAAP perspective, you need to record all the assets at fair value and to put them on your balance sheet at day one here. Those going forward, then some of the assets will be amortized or depreciated, and some of them will be tested for impairment annually as well. So it's important to say, all right, if I'm purchasing a business for $500 million, then what am I really acquired? Did I acquire a bunch of goodwill? Did I acquire some brand names? Did I acquire some fixed assets and inventory and cash? Okay, great. I need to measure that. I got a big piece, but what's the components of that piece? So that's that purchase price allocation. It's important just to take a step up because when you're doing the debits and credits, I'm going to credit cash or equity. I'm going to debit all assets acquired then. And then likewise on the tax side of your tax books, you're going to have to do something similar as well. Luckily, the tax books can largely follow the GAAP books. So you're okay there.
What if I have one of those earnouts that we talked about earlier? How is that going to affect that purchase price allocation that I need to do?
So let's say you've got a transaction where you're going to pay $500 million of cash. Let's say we'll make it easy. It's just an earnout as well. And so it's $500 million of cash plus an earnout. So you're going to have to record from a purchase consideration or purchase price perspective that $500 million of cash plus the fair value of that earnout. Let's just say you've done that and that's $50 million, the fair value that is. So then your purchase price would be $550 million. Your then purchase price allocation would allocate the values of all the assets acquired to the $550 million, which includes the earnout as well. Likely the plug could be to goodwill, but also may affect the other intangible assets. So again, you just need to fair value that earnout on day one. It'll increase from the amount of cash that's exchanged, but likely lower than the gross value of the earnout that you may have to pay as the buyer.
Do I have to do any work on an ongoing basis to value that earnout from a liability standpoint?
That's a great question. It depends. So sometimes earnouts are classified as liabilities, which is I'd say most of the time, and other times they're classified as equity. If it's equity going forward, you won't need to do anything else. But again, I think that's the minority of cases. So the majority is that earnout is classified as a liability. And yes, you do need to mark to market or remeasure that earnout every financial reporting period. So let's say your earnout is over 3 years. Every year end, then for your auditors, you're going to have to remeasure that earnout at fair value and change the balance on the balance sheet and flush it through the P&L as well.